Welcome to the Real Estate Podcast, where we decode the trends, strategies, and insights that drive smart property investment. I'm your host, and today's episode is all about valuation, how we determine the true worth of a property. This episode is titled, Property Valuation, What Really Affects the Price of Real Estate. It's a deceptively simple question. What's this property worth? But ask 5 people, and you'll get 5 different answers. An agent will say one thing, a bank another, and an investor something else entirely. Let's begin with a real case. In 2020, a client of mine in Houston was looking at 2 seemingly identical duplexes on the same block. One was listed at $450,000, the other at $535,000. Same square footage, same year built, similar condition, so why the $85,000 difference? The answer, valuation inputs. One had tenants on long-term leases, generating steady cash flow. The other was vacant and staged for sale. One had a new roof and HVAC, the other didn't. And critically, one was in an opportunity zone with tax advantages. This brings us to the key point. Property value is more than comps. It's a multidimensional formula that blends objective data with market perception. Let's break down the core factors that influence real estate valuation. 1. Comparable sales, comps. This is the foundation for most residential valuations. Appraisers look at recent nearby sales of similar properties, ideally within a 1-mile radius and sold within the past 90 to 120 days. But investors should go deeper. Were those sales distressed? Were they cash or financed? Was the square footage adjusted correctly? Comps are the starting point, not the final answer. 2. Income-based valuation for rentals and multifamily. The income approach matters most. That means net operating income, NOI, capitalization rate, cap rate, local rental demand. You calculate value based on expected annual income divided by cap rate. This is where small changes in rent or vacancy assumptions can swing valuation dramatically. 3. Replacement cost. Especially relevant for new construction or insurance purposes, this model calculates how much it would cost to rebuild the property today, including materials, labor, permitting, and land. Replacement cost sets a ceiling for value. Buyers rarely pay more than it would cost to build new, unless there's intrinsic value in the location. 4. Market sentiment and timing psychology matters. In a seller's market, buyers stretch. In a buyer's market, discounts appear. Timing, interest rates, and even seasonal behavior affect price. 5. Intangible and localized factors. Things like school district ratings, walkability scores, crime rates, and even social proof, e.g. big-name retailers moving in, all influence perceived value. Let me give you an example. In Tampa, 2 homes in the same zip code were valued wildly differently. Why? One was in a gated community with HOA-managed landscaping and security, while the other sat on a floodplain requiring high insurance premiums. Same size, same age, different story. Now let's talk tools. For residential, Zillow and Redfin for broad comps. Realtor.com's price history feature. Local MLS access if you're licensed or working with an agent for investment property. PropStream and Property Radar for comp analytics. Rentometer for rental benchmarking. DealCheck for underwriting scenarios. Pro tip, always run your own underwriting. Never trust the seller's pro forma. If their numbers seem too good, they probably are. Here's a framework for valuation. 1. Pull comps within the past 6 months, filtering for similar bed bath count and square footage. 2. Adjust for condition, amenities, and financing type. 3. Run an income-based model. If it's a rental, compare NOI and cap rate. 4. Look at the replacement cost. Get a sense of construction cost per square foot. 5. Factor in sentiment. What's inventory doing in this submarket? How many days on market? Multiple offers or price cuts? So what's the takeaway? Valuation is both an art and a science. Your goal isn't just to know what a property is worth today, but to project what it could be worth tomorrow, after improvements, after repositioning, or with optimized income. Thanks for tuning into this episode of the Real Estate Podcast. If you want more tactical breakdowns like this one, hit subscribe, leave a review, and share this episode with someone analyzing their next deal. Next time, we'll cover oceanfront property, high risk or high reward, and how to evaluate coastal real estate under climate pressure. Until then, know your numbers, challenge your assumptions, and always underwrite twice.